got Tommy. So Tom, why don't you just talk a little bit about, before I get started, I just want to let everybody get here about where rates are and how it's like for an investment property, and then talk a little bit about what we discussed about, instead of building the premium in, if you're going to be long-term, about paying a little bit of money up front. So we'll look at that.
So Rob and I, we did a lot of analysis on what it would take from a finance end for not only yourselves as real estate agents, but your clients as clients to buy an investment property, and what's the strategy? How does it make sense? How do you build long-term wealth? And we found that it's best to get a 15-year mortgage and have obviously the tenants pay the 15-year, and to buy the rate down. So we put together some factors by paying points, and generally, depending upon the loan amount, it probably makes the most sense to buy down the rate by 3 points. And we wrote down some figures, but generally it's saving you about 1.25 on the interest rate. And because this is a long-term wealth strategy, the break even is going to be there for you from a cash flow perspective, because you're probably going to end up having a 5-year break even. But the idea is to have the tenant obviously buy down that mortgage. So we did a lot of analysis, and Rob, I didn't write down the numbers because I thought you were going to do that part.
Tom, I have the details, but I just wanted to go over the main concept.
Okay, so conceptually, let me just give you a little explanation on rental financing from a bank's perspective. When I say a bank, I'm talking about Fannie Freddie mortgage company compared to commercial lending. And both are okay, but I'm going to start with Fannie, and then I'm going to move over to the commercial side. So I'll give you the good, the bad, and the ugly, and the benefit on the Fannie side for buying an investment property. So first of all, if you're buying a one-family investor, you can get in with 15% down. If you're buying 2 to 4 units, you can get in with 25% down. Like any other loan, when we qualify someone for investment, we're going to qualify the income from the borrower, but we're going to be able to use I don't know if I froze up. Okay. We're going to be able to use the rental income on the unit. So a lot of times we're going to help to get that person qualified, because we're going to take the rental income that comes off the appraisal. They're actually going to do an income approach. We're going to see what the projected rental will be, and we can use, depending upon the program, X% of that rent for you to qualify. I'm going to flip it for a minute now, and let me talk about a realtor, because in a lot of cases, even when you file your tax returns, you're going to wash out a lot of your 1099 income with expenses, so you don't have to pay Uncle Sam. So a lot of times when a realtor comes to me and they say, hey, I want to buy this investment property, when I look at the income, and yes, somebody grossed $200,000 last year, but they had $190,000 in expenses, so I can't find enough income even with the rental income to get them to qualify. In that case, I'm going to go to commercial. And just so you know, generally speaking, without buying points, you're roughly looking and you're looking at the building cash flowing. That's all we care about on the commercial side. So the great news is, if someone doesn't qualify for financing due to income on the Fannie side, I'm going to have them go out, start a brand new LLC, buy the property in the LLC, and as long as the property cash flows, they'll be able to get that commercial financing all the time. Now, typically on the commercial side, what they look at is, number one, they look at your background. They want to know if you've ever were an investor before. If you were not an investor, that's fine. But typically you're going to have to put down a minimum of 25 to 30%. If you've never done a transaction like this, you're probably looking at 30%. If you're an experienced landlord, I can get you in on the commercial side with 20% down. So again, the range is either 15, 20, 25, or 30, depending upon the program, but that's kind of what we're looking at it, but it's a case-by-case basis.
Tom,
so that's a little bit of how we
So Tom, Bruce has joined us, and Bruce, do you have any commentary on that?
What are you
Is
talking
it
I'm
about
afraid I didn't hear. I'm afraid I
so
came
so
late. I'm
so
sorry.
so basically, down payment for 1 to 4 family investment properties. What are we looking at?
So I just said it, Rob. So if you're buying a 1 unit, it's 15% down. If you're buying 2 to 4, it's 25% down. That's on the residential Fannie side. I call it residential, even though it's an investment property. It's a 1 to 4 family unit that's categorized as residential for Fannie Mae.
Now, is that the Fannie guidelines, or
Yeah,
does that have
it's Fannie
overlays on
Freddie
it?
same. No,
Well,
that's
that's Fannie guidelines typically. The overlays are now when you're talking about overlays, are you talking about underwriting overlays or are you talking about pricing overlays?
I'm talking about like underwriting overlays. So like for Fannie Mae, like Finance of America and Better Way would be using the same criteria: 15 on a single and 25 on the 2 to 4.
Correct.
Same with you, Bruce, right?
well, Fannie. I mean, there's other products. We're a commercial group where if you're doing fix or flip, you could do 10 or 15%, but that's all LLC. It's a different thing. But Fannie Freddie, yeah, that's pretty much the same stuff.
Perfect. So
I mean, there may be some overlays where people don't have as aggressive down payments either, but fortunately, we both neither one of us have that. So.
perfect. So I want to get started into like the analysis of what we have here, and I want to thank our lending partners for making themselves available. They're doing that for us, and basically this webinar that we're doing here is to encourage you and educate you to maybe put some money aside, albeit we don't have a 401k, we do have access to right at our fingertips, probably some of the best investments that you could ever make. And these are hard assets. And if you don't need to sell them quickly, I believe that, if the market fluctuates, and we're going to go over next week, what about the market? Like, are we nervous about the market softening, crashing, whatever? I have an entire hour with Robert Garver, and I are going to discuss that. And then 2 weeks from today, we're basically going to take some investment properties and we're going to see if we can take action, start to make a few offers and get in the game, so to speak. So I've got a pretty aggressive calendar for us, and I don't care if you want to go and do this on your own or if you want to do this as a group and kind of pool the risk. But I really want to inspire you to invest in what we work on. Okay, and I really believe in it. So let me take a moment and go through. If you guys have Advil, Tylenol, anything for headaches, you might want to take it now because I'm going to crunch through a lot of numbers. And before I do that, if you could put your cameras on and just raise your hand when I ask some questions, because I want to get an idea here of where we are. But I'm going to open up my sheet on a different computer. And I'm going to discuss some of the stuff that I was working on. So who would be happy with a 6% return on an investment in real estate? Anybody? Raise your hand. Paul, you're a sophisticated investor here. When you define a return, if you put $100,000 down on a $500,000 house, what's a 6% return to you mean?
Sorry, ask me the question again.
So if you're to buy a house for $500,000, I'm making the numbers easy. You put down 100, right? Let's just say 20%, or you buy a house for 400 and you put down 100. When we talk about a 6% return, what does that mean to you?
Well, I mean, are you talking about the cash on cash? Or are you talking about
that? It's a setup, Paul. So, but what would a 6% return that you were open to? What would that mean to you?
I mean, so if I was cash flowing $6,000 a month or $6,000 a year on $100,000 invested, I would be happy with that.
And what if you paid your note down another 6,000? Would that be a 6%, or would that be a higher return for you?
I guess technically it would be a higher return, right? But are you talking a return in actual dollars? Or are you talking about a return because I'm theoretically getting more appreciation or depreciation or something like that, right?
So I'm talking about equity built paying down your debt. I'm taking appreciation, depreciation off the table.
So that is a little bit more sophisticated than I am. I tend to think of the cash flowing in, and I mean, I know those other things are important, but it wouldn't necessarily change. I mean, it's better, and I know it's better to pay down $6,000 and have an increase based on equity. But I would, comparing that to an increase in the actual dollars flowing into my pocket, I would prefer to have more dollars flowing into my pocket on a monthly basis.
So if I said that using my if you can, I'm going to ask you just to put your cameras on so we can feel like we're a little bit more together here. But on my sheet where I did a complete download of all the data, and I personally ranked them by things that I thought were important, like cost per unit, return on investment, sale price to assess value. Now, albeit any one of those could be deficient, you could punch holes in them, and it's only as good as the data that's being reported. But with the 7 properties that I came up with, the cash on cash return for a 15-year investment, 5 of them had 11% or greater, and 4 of them had 15% or greater cash on cash. That doesn't even include the building of equity by paying down the debt. And on those ones with building, I just want to get everybody a little bit juiced here. For the total ROI with building in the appreciation, the top 3 I had were 20, 22, and 26%. Now, is that pretty damn interesting without any appreciation on there? Please, folks, put your camera on if you want. I want this to be a little bit more interactive, so I feel like I'm in a board meeting here. So those are the numbers. Now I'm going to go in and I'm going to show you precisely how we come up with these numbers. And more importantly than showing you, I want to educate you, not to be a spreadsheet guru, but to understand the principles behind it. Okay? So I'm going to share my screen now. And this is my investor sheet. Just move this down here to, okay. So on this sheet here, I assessed 7 properties that I did my little score here. And I took I looked at the properties that were 200 or double the average criteria that I felt was important. Double the average criteria. That's what it took to make it onto my list. So out of 253 properties, out of 226 properties, I cut it down to 7. Now, I think analyzing 7 properties is a hell of a lot easier than 226. And this spreadsheet's going to eliminate a lot of them. And I think we probably should go deeper if we're serious about investing, because there are some flaws in the data. But, we shouldn't be focusing on the bottom ones, because those are the properties that just never make any sense. So when I took this, then I took the 7 properties over here, and I ran my numbers on them. And I'm going to walk you through the entire process here. I'm going to make this spreadsheet available to you. And if anybody wants to learn how to do it, we can do a special workshop on that as well. So I have the property address here. I have the list price. If it was a 2 to 4 family, I put 25% down. If it was a mixed use or a 5 family, which one is mixed and one is 5, I took 30% down. So I have paying list price, and mind you, all these properties have been on the market for a while. So it seems like part of the strategy is to identify the ugly ducklings here that haven't been snapped up. And for better or worse, some of our peers don't do a really good job when they put these properties on. Okay. And what I mean by that is when I exported the data, one of the properties had the net operating income backwards with the expenses. So it showed that the net operating income was 9,000 and the expenses were 35 on a $45,000 gross income, but the agent flip-flopped the numbers. So it really took a little bit of due diligence, but this took me about an hour to get done, just so you know. I took the 25% down. Here's the down payment. Here's the mortgage. I used 3 3/8, 3.375 for a Fannie Mae 30-year. I used 2 5/8 for a Fannie Mae 15. I used 4 3/4 for a 30-year commercial loan and 4 1/4 for a 15-year commercial. These numbers might be off a little bit, but they're close enough for analysis. And the numbers are pretty telling. And then I created a saved search. So I'm going to share with you the saved search that I did. So for the, let me see which one's pretty interesting. So I'm going to take us to the MLS. So this first property here, which is under contract, continues to show, might not be available. But this one here is a 3-family, and it's on the market for $385. It's been on the market for 290 days. So my antenna is up. There might be something wrong with it. Sold strictly as is, pre-existing non-conforming use, 1 of 3 units occupied, vacant units move-in condition. Needs some investigating, but and I can look at the listing archive here.
Septic there. There's an oil. So there could be, there's a red flag there.
So definitely there's some red flags that we need to look at. We could even go to let's even say a super simple place like this. Cannon Mine Road in Ringwood. Okay. 185 lowered to 179. Straightforward 2-family home, 2 bedrooms, 1 bath. The agent did a fantastic job with posting photos. What do you think, guys?
Mm-hmm.
Isn't that impressive? I mean, I think that's the back of the house, if I'm not mistaken. They couldn't take a front picture. Anyway,
Might be flood in Renwood.
I'm sorry?
Might be flood.
Might be flood. Okay. So, and I do think some of these properties might have those exposures that might be eliminating them from our consideration. Okay. But I just want to go through like some of the macro data, and we can look at it, and then we can look around. It says oil tank above ground outside.
That's not bad.
And this one is
The
20.
septic. You don't know how old is the septic and what goes under,
It could be a pretty big ticket if it needs to be fixed. I got you. But that one was 20 Cannon Mine, right?
Yeah,
So,
the location is not that good, Rob.
And you know what, Anthony? I don't really care that much. And this one's not even our better performing one. Let me look at, let me see 7 Humphrey. I want to look at something a little bit more exciting. 7 Humphrey. So 7 Humphrey in Clinton. On the market for, actively on the market 47 days. It's a 3-unit, 16, 1350, and 740, a 1, 2, and a 3-bedroom. Those rents don't look too far out of line, to be honest with you. You might even have some room once you study that rental market. First tenant lived there for 11, second for 20 years, third tenant moved out 1 year ago. So if a tenant's been there for 11 and 20 years, does that strike anybody? Does anybody have any comment on that in terms of opportunity or concern?
I would think it's a good opportunity because they're already happy, obviously living there 20 years.
They're probably paying well below market rent.
Bingo. That's
I
what
would
I'm
agree.
saying. If somebody's been there for 20 years, we all come across landlords that don't like to raise the rent because they don't like to have the vacancy and the aggravation of having it turn over. But there might be some extra opportunity there now that the market's up and the rental market's a little bit hotter. Would we all agree? So these are the things that I take into play. But just in reviewing the numbers on this property here, I know I have too many tabs open. Reviewing the numbers on that one was 7 Humphrey. So we paid full price. It's been on the market for 47 days, so we might even be able to do better than that, right? We have closing costs, but we also have commission money to play with. We put down 20%, but roughly $100,000. We mortgaged about 300 on a 30-year scenario, 3 3/8. Our annual payment on that's going to be about $1,250 a month or $15,000.
Hey, Rob, are you sharing your screen with us or not?
Oh, I guess I stopped sharing. Hold on.
Yeah.
Good point.
On the 300,000, what did you estimate the monthly payments?
So here it is, right here. This one's 7 Humphrey. I'll highlight it. I'll put it in yellow. So 7 Humphrey, roughly 400, 100,000 down, $300,000 mortgage, 3 3/8, 30-year fixed rate. That's the factor per thousand. This is the gross rental income. This is the mortgage payment, okay? And the mortgage payment, the taxes are included in the operating expenses, so the actual payment you might be making would be higher, but it's already factored into the cash flow. Your taxes and other expenses are reported to be $9,500, giving you a net return of $19,951. You're paying down almost $7,000. In my opinion, your total return on this is $27,000, $26,500 on a $100,000 investment. Who's joining me on this one? Hold on, Paul. Did 3 people drop off and log into Dot Loop right now?
What? Huh.
I saw you. I took your names down. Whoever did that, but no, I think that's a pretty good return. Who has investments in property right now and wants to just unmute yourself?
I do.
And
I
who's
do.
speaking? Because I can't see the names. Who's
Sarah.
Sarah?
Property Sarah, yeah.
And who else?
Anthony.
Anthony. So Sarah and Anthony.
And
If you-
Janet.
and Janet, if you guys can put down $100,000, right, and get a $1,600 a month positive cash flow, and you can have a $26,000 return, assuming that these property, like there's not defects that we're not seeing. Does that on the surface seem like a pretty darn good investment?
Yes, absolutely.
Yes.
Yeah.
All right.
Hey, Rob. Sorry, I'll turn on my camera too. This is Maiken. How do you factor in like maintenance to the building, or, some of these houses are super old and you don't really know what's going on. I mean, I guess you would do inspections first, but how do you like pre-plan for what you want to save to pay down any, kind of issues that happen?
So you are very observant and that's very astute question. I'm going to go over that as well a little bit later on. But like what happens is if I put too many factors in, we will get analysis paralysis. Do you ever,
all the time.
Do you ever get afflicted by that?
Yes.
So what I want to do is I just want to go with the general concept and just say in a fairy tale world, right? Wouldn't a $26,000 return on $100,000 be like a fantastic investment, right? And who knows these local areas better than the 53 people on this call? Nobody, right?
Mm-hmm.
So I really think that this is a tremendous, opportunity for us to at least think differently as we're going through our real estate careers and look at things and say, hey, maybe I ought to put this through and give consideration to it. And, as a group, we have the opportunity to, potentially invest together. I don't know if anybody has seen that, uh, Charles Schwab and maybe some other companies. I saw on when I was geeking out on YouTube, they said you can buy slices of shares. So you can buy a $5 piece of any stock. So you can buy a $5 slice of Berkshire Hathaway, which is probably $100,000 a share or some ridiculous number. So what I think I want to, not what I think, what I want to do is I want to make real estate investing available to anybody that's part of our family here. So like if you only have $5,000 to come in, maybe we can get you a piece of a transaction and get you started in the game. And if you had, $5,000 pieces in 5 properties, it would hedge your risk if one property didn't perform particularly well, or if another one was an exceptional winner. Because if we bought, 5 properties, obviously one's going to be the best performer and one's going to be the worst. And we don't want anybody to draw the short stick. So that's one of the concepts I have here. But the main thing is I just want you guys to, look at, guys and ladies, to look at investing in real estate. So we're going to come back to your question later because there are other things besides like, repair reserves and management fees that I didn't put in here, but I do have those addressed. Okay.
Thank you.
You're welcome. See you, Paul.
Rob, one question for you. When you was talking about the pay down of the 6,000 on that 30 year, how much are you saving over the long haul with the pay down? Like what's the amortization get cut down to?
Well, no, that's just in the normal amortization, Brian. That's not paying anything extra. So that's just saying if you did the 30 year right over the first year on a $300,000 note, you'd pay it down by $7,000.
Okay.
Okay. So that's nothing extra.
Okay. Gotcha.
Now I'm going to go and share my screen again. And I'm going to go and take this same property here. Now let's look at these numbers. So our cash return is 19.5 and our real return is 26.5. I take this down and I go to 2 and 5/8, right? Instead of a 3 and 3/8, which is a 0.75% savings, right? Our factor goes up. Our total return.
You tell us what that factor means, Rob?
So if you borrow $100,000, it costs you $8.43 a month, or per thousand is $8.43. So you borrow $100,000, it's $843.
Got it.
If you've been in the business a long time, you used to have these little charts where it'd say if you borrowed $100,000 at 6%, it told you a number. Does anybody remember those besides me? Probably not. But anyway, you can take that factor, and if it was double the price, you just multiply it by that. So this one over here has a, I might have an error in my formula here, but this one here has a cash return of 5%, and my total ROI doesn't seem to make sense. I think it's a little bit wrong, but it's going to be about 4% higher because this 3.89% is going to be the 3/4 of a point times 5 because we're leveraged. Okay, so our cash return is going to drop, but our total return is going to go up by almost 4%. Okay, so we would still be generating a cash flow positive of payment expenses net. We'd still be generating $5,200. We would be amortizing instead of 6,000. We'd be amortizing almost 18,000, and our total return should be 3.9% higher. So I just have to double check my formula. So it might be 29, or maybe the 26 is off. It's only like 21. But does everybody get the concept?
Yes.
And if you could put $100,000 down, right, and you get $400 a month roughly, right, 425 a month, positive cash flow, and you're paying your note down by 20 grand every month. That means that your $100,000 equity becomes 120 in year 2 without any appreciation. Year 3 becomes you have 140,000 plus 10 grand return. I think that's a pretty good return. If you ever go to put your money in the bank, you get like 0. Everybody with me?
Yeah.
Now, is there anybody who's going to be brave and tell me that you want me to explain something a little bit better?
Rob,
Yes.
Janet here. I'm just trying to understand this factor that you're using. How do you come to that factor?
So if you ask one of your lenders or you go online and you look at how much does it cost to borrow 100,000 at 3 3/8, it will give you a number of $4.42 per $100.
It's an amortization factor based on the rate and the term. It's a steadfast fixed number. So there's a chart that has 5-year term, 10-year term, 20-year term. There's always a steadfast number. So it's not anything you have to figure out. It just is what it is. So you could just always look at the factor.
So it would be
I
on my
could-
documents.
Yeah, we could send you, you could find one online, or we could send you an amortization schedule. No
Yeah.
problem.
So the great news, Janet, is if you know that amortization factor, all you do is you plug it in, and you don't have to keep calling, Bruce or Tom with each property saying, "Hey, how much would this be?" It gives you that number automatically. Okay. Anybody else have any questions before I kind of go a little bit deeper?
Yeah, this is Mark. You say that we're not taking into account any appreciation, so that makes it conservative. But on the other hand, I think the biggest risk is a fall in value because we're leveraged. And so I'm just wondering about that. How secure would we be relative to real estate pricing fall?
So Mark, great question. And that comes under risk tolerance. And I'm also going to say that, things like major repairs and, who could have predicted what do they call it? A moratorium on evictions, right? So if you happen to have a tenant in there and we get COVID-21, right? And our authorities say we can't evict anybody, we might have a problem. True? Mark?
Yes, yeah, definitely.
So there's a bunch of risk factors out there. So, if you had a single family and the tenant's not paying, you need to sell more houses is what I would say, right? But if you had a multifamily and you had some cash flow, it might just be an inconvenience instead of a major problem. And I'm gonna take a look at this 7 Humphrey. Where's that one? Seven Humphrey is in Clinton Township. So check out this. I know we all hate Zillow, but here's that property. And I look at Zillow and I scroll down here. Let me see if they have a Zestimate history here and they give me any predictions. So the home, oh, well, look at that. The home is valued 5.9% lower. And Zillow predicts the home values in that zip code will increase by 10% next year. So we're not considering that at all. So if we're at 26.5 and Zillow expects 10% appreciation, that is pretty darn good, right? Now, what does 10% appreciation do for our investment? So if we invest $100,000, what does that do for our return? Who wants to give me a guess at that?
On a 400 price, it's a ton.
Right. What's the
40 grand.
so I'm going to exclude Bruce and Tom. So any agents here want to tell me if that property has 10% appreciation and we're at a 26% return, what does that do to our return?
Doesn't it compound the return?
You can't answer a question with a question, Anthony. Who wants to answer the question? This is
doubled it.
This is why we're here. Okay. So is Mark, are you still on?
I am.
Okay. So Mark, if we are leveraged 75% and we get a 10% appreciation, what does that add to our return?
I think it's, is it threefold or fourfold?
40, it adds 40% to our return. So we have a 67% return.
Yep.
Now, can I tell you, this leverage principle could work the other way, right, Mark?
Yeah, well, this is the question, yeah.
So if it goes down 20%, we can theoretically get wiped out. But if we're buying properties that cash flow, even in down markets, the rental market does not go down as quickly as the property value, right? Everybody with me on that?
Yeah.
So I say, and you should write this down, so what if property goes down as long as we're in for the long haul, right? So what if property values go down? If we're a long-term investor and we're paying this down to zero on the note, in 15 years, what's the probability of this being worth, if we pay 400, 15 years from now, is it more likely to be worth 200 or 800? What do we think?
800.
Does anybody think that there's any realistic possibility that a $400,000 house today that was a good deal will only be worth 215 years? So there's no reasonable person going to accept that theory. And I think most reasonable people with modest inflation and compounding, it's likely that it would be 600 to 800 or maybe even more in 15 years, right? So we can get in for 100 and 15 years from now walk out with 800,000. Does that make sense? And I don't care if the property value goes down 100,000 along the way, as long as I'm looking 15 years down the road and I have the rental income to support it. So what? Is this resonating with some people here? Does that make sense?
Yes.
Yeah, absolutely.
Absolutely.
So
Janet has a question, Rob. Janet has a question.
Okay, Janet.
Raise her hand.
Oh, no, I didn't have a question. I just
I thought you raised your hand.
all day
Sorry.
long. Thank you.
All right. So I see we have, I don't know if Dave is on here just being curious, or if you're interested in buying a little bit of multifamily juice, Dave.
Absolutely. Always looking. So I'm looking right now, as a matter of fact.
Fantastic. And then we have, for those of you who are new and don't know, we have Carlo Caparuva, who runs our commercial division. This whole theory here, I have to hand off to Carlo, because we get together probably every 2 to 3 weeks and we talk about what can we do for the team and the agents and provide extra value. One of the things is, giving you a reliable resource to refer some commercial deals to, which we've been paying out some pretty big checks. The second thing is both Carlo and I I can tell you, I'm in the real estate brokerage business because I love real estate. And I think you are too, Carlo, right?
Been doing it for too long, so I must be, or just a glutton for punishment. I'm not sure which.
No, but we love it. We're real estate people. And, Carlo and I are putting together a syndication with an opportunity to buy into some bigger commercial deals with a bunch of people if you want to do it. And, I am not doing this for me. I'm doing this because I really believe in what we're doing. And, it'd be nice to own a piece of the Bank of America building like Carlo does in Maplewood, or some other opportunities that he's bringing. And, Carlo's saying, Rob, why don't you offer like pieces of these deals to some of the agents so that they can benefit from the business that they're in? So Carlo, thank you. And I see Audrey, you still smiling from this weekend? So unmute yourself for a second and just, was door knocking brutal?
No, it was fun.
We did not find one curmudgeon or negative person when we were door knocking, and I'm going to go back and I just sent the calendar out to the managers for upcoming door knocking if that's your thing. So Carlo,
Yeah.
Let's talk about the management of the property. Some, what would you call it? Repair reserves. And the appreciation and how we should kind of factor all these pieces in when we move in this journey.
When we do underwriting?
Yeah, when we underwrite the opportunity. What he means is not underwriting the mortgage. He means together as a group, if we're interested in some properties, like maybe there's 5 of us that want to buy in on this one property that we're looking at, right?
Mm-hmm.
And we all put up 20,000, or maybe somebody puts 30 and somebody puts up 10. We have a formula, and the way that I would suggest doing it, and I think it was Bruce or Tom had mentioned that some agents have really good accountants, or some agents aren't yet making enough money to qualify. That we would have a guarantor. So if somebody wanted to sign the note, they would get an extra. I propose 1% fee. There's enough room in there. And they would be on the hook if the thing went south. And that would make it available for somebody to come in for a smaller piece, or to come in without having to sign a mortgage that shows up on your credit report. So that's my piece. If you want to talk a little bit more about the management, because I don't want to go and unclog toilets. I don't want to have to go and deal with applying for a CO when it turns over. What does that cost, Carlo, if we hire professional management, and is it feasible to fit those in with something that has a 26% return?
Sure. And forgive me, like I'm in the middle of an empty supermarket. So like shutting off stuff so I don't trip the alarms, which I already did once today. Anyway, so when it comes to a property, you want to do the management where, if you're part of the investment group, you really don't want to be showing up and running around doing things at 2 o'clock in the morning, which always happens. And whether it's res, or doesn't matter if it's residential or commercial, whatever, residential, multifamily, commercial, it's all the same. You always get that call because you get a pipe break or whatever, and it's never during business hours. Let's put it that way. So when we hire a third-party manager to do that, and we have that management capability, basically you want to underwrite it and it really goes to an economy of scale. When the larger the property, believe it or not, the less percentage that you will wind up underwriting it at. When you're talking about small, like more on the residential side, you're going to start hitting a number. You're going to start hitting a number anywhere between 5% to 5 to 10%. A lot of times settling at about an 8% number when you're underwriting that for the management. But that's also for management that's doing everything. That we're not doing a thing to it, because we actually have other jobs, and our time. I mean, we should all know how much our time is worth per hour. Mm-hmm. I can't afford to spend that time doing it. So anyway, so that gives you a sense. What we also do is, so when we start underwriting it, we want to look at certain elements. We want to look at a structural reserve, depending on the property. Maybe you take out X amount of cents a square foot. When we're looking at if we're looking at structural, if we're looking at, depending on the tenant, you would have credit and collection laws. There's just a variety of just small line items that are there that what it does is when we're underwriting it, there are just certain reserves that we have in case things happen. But the most important thing is to make sure is that we have management in place. That is key.
Right. And over time, I think, if we own a property out, but if we own a property out for 15 years, there's going to be times when you have, a furnace that breaks or you have to replace the roof. And if you budget for that and you have credit facilities that might not even impact you. So if you have a small credit line with the bank or you put something, on a credit card with interest free for a year and you pay it off, like there's some creative ways that I can foresee doing some of these activities where it's not digging into our pocket. And, we have the smartest minds in local real estate that are sitting here on this call. I mean, I'm not trying to brag, but, we're at Remax. We're the most productive agents. We're committed. And if we could band together and find a way to do this, I think this could be like a game changer for our retirement. It's better than a 401k where they match your investment. Like this is, you're not going to get these returns long-term in the stock market. As a matter of fact, the stock market scares me, maybe because I don't understand it enough. But if I buy a piece of real estate and I hold it for 15 years, I'm pretty confident that in 15 years it's going to be worth more than it is right now. And if it pays for itself, I don't really care. I see Nicole shaking your head. I don't care if it goes down by 20% in a few years. I hope not, but I don't want to stop making my investments right now. So my plan, if you're interested, is next week, Robert Garver and I are going to kind of look at the positives and the negatives, look at the yin and the yang of whether values are going up or down. Is the market overvalued or undervalued? And then I'm going to be working through putting together a list of properties. And if you are interested in getting in 2 weeks from today, I want to either have offers on properties that I've secured or start offering with people in this group to make some initial investments, because at some point we need to make a line in the sand and start. And somebody, was that
I'm sorry, that was me, yes. There's a question in the chat box that I guess is taking the long-term view of this, but how does an investor avoid high tax gains when they sell a property?
1031.
So look.
Well, but also if it's an investment property, it falls under capital gains, and that's a significantly different tax rate than income tax. So you could have a capital gains tax up to $500,000. I think it's $500,000. It's like 15%. Versus if you have $500,000 gain on an income tax, it's a lot more. And then on top of that, you can keep in mind from a tax perspective, Rob, that if you don't need a 26% return, just on $100,000, you're going to get about $3,600 a year in depreciation, which is a BS expense to defer income. In other words, you get $3,600 off for every $100,000 if you depreciate a property. So what you could do is, since you don't necessarily need to show the income, you could use the depreciation to have a shorter term loan, and you could pull money out of the property every 10 years tax-free. So you could accelerate the payment, have it actually show a break even or a loss, defer income, and when you pull the money out every 10 years, it's tax-free. That's if you're going to get into tax pieces, at the cornerstone of all the most rich people in the world is real estate. And that's very much how they do it, or at least that's been my experience.
So how would you be pulling the money out at 10% a year?
You cash out the financing. So if you do a short-term loan of 15 years, for example, and maybe you take that depreciation of $18,000 on a $500,000 home to cover the additional payment for a 15-year term, instead of you showing a gain every year, in other words, money you'd have to pay income tax on. Instead, you don't show a gain, or maybe you show a loss, and then every certain amount of time, 5 or 10 or 7 years, there'll be equity because it's a 15-year term, and the equity that you pull out and you take and you split is all tax-free.
So I'm gonna tie this subject up because we have 8 minutes left, but I'm gonna say that real estate has inherent tax benefits to ownership. Okay. And you have a hard asset behind it. So, I mean, we could debate it for hours. And Bruce, I think your points were, very well taken and unmentioned to this point, which is above and beyond like the charts that we looked at, right? The fact that you make $8,000 and you might even be able to get a small tax loss every year. So you're building up equity, right? You're getting cash in your pocket to buy the next property. And then when you go to do your taxes, it says that, oh, we add depreciation, we have a small loss. How cool is that, folks? Like, this is the only asset class that I know that you can do this. So Bruce, I want to, thank you for that. I'm going to go back to my spreadsheet here. And if there's any questions, can you put them in the chat? And Robert, can you just check the chat box and bring that back to me if there are any? So here's the, compound effect of appreciation. Okay. If we buy the property, let's say we paid 400,000 because we need to put 20% down. We have a 4% appreciation on that property. We're getting we're getting a $16,000 appreciation on our 100,000, right? And if you believe long term that real estate's not going to appreciate by 4% or better on an annual basis, I'm going to take this off, and we have 53 people on. Log off if you don't think real estate's going to appreciate by 4% on average in the next 15 years. All right, we're still at 53, Robert. That's good. I see some more questions in the box now.
Yeah. So first, there were some questions about defining an experienced investor. Would that be if I own a 4-family and I live in one and I rent out the other 3?
That's going to be more subjective. And let's assume that the experience criteria, since we're all licensed active real estate brokers, that we can meet that criteria with a lending institution.
Okay.
Let's go to the next one.
One is, would you cash out on an investment if it valued twice your initial purchase?
Again, that's something that as we set these investment groups up, that we would decide as a group how we're going to handle that. My belief would be that we make it easily transferable. Like if you want to get out. So let's just say Lillian, myself, Rob Garver, Julio, and Tom Marinello, you guys are the front line of my screen here. If we all decided to buy a property and then 5 years from now, Julio decided that he wanted to cash out, we should have an equation for Julio to cash out if we don't want to sell the property. And maybe as a group, maybe all of us say, hey, we want to be in this for 15 years. And then once we get to that 5-year mark, if there's, if the property has more than 50% equity, maybe we take some cash out and we buy another property, right? Maybe the next group, which is Anthony, Hyun, Bruce, Jesse, and Dave, maybe they're saying, hey, you know what, in 10 years, we want to cash out of the whole thing. We want to go retire in Central America and call it a day. So that might be a different investment objective that we have. And I think it would be helpful if we kind of had a little bit of a kind of an aggregation of people who had similar objectives from the onset. So
the next question is, can you start the investment in an LLC vehicle in Florida to make it New Jersey state tax free?
I don't believe so. Well, if you live in New Jersey, then no, you can't.
Jersey.
If you have an investment property in Florida and you live in New Jersey, and I'm not an accountant and we'll get an accountant on, but if you live in New Jersey, you get an investment in Florida, you're going to pay income tax in New Jersey. If you have an investment in New York, right, and you live in New Jersey, you're going to pay income tax in New York, and then New Jersey is going to give you a credit for what you paid in New York.
Okay, the next one is, are you looking to open up a portfolio to an STR model as well?
Am I looking to open up a portfolio to what?
An STR model as well.
SPR or SFR?
I'm not sure what
STR, short-term rental model.
Oh.
Short-term rental?
Yeah.
So I didn't even figure that. In Florida, I think, yeah, there's opportunities to buy things where you can do like
VRBO,
V-
AR, like that.
Airbnb. Yeah, I'm not even going in that area, Brian.
Yeah.
I'm looking at like low risk, across the board, monthly rentals. But
The
there
reason
are,
why I say that is because it will mitigate the risk, as what you said before, prior, about if we get hit with another 2021 COVID and you can't evict. At least with this, when you're doing a short term, you got the most they can get out is 28 days.
right. So look at, I mean, those are different things that we can look at, and you guys have great questions here, but I just think that hey, if you're interested, let's see if next week we don't shake you off the stick, right, with the conversation about what could possibly happen. All right, and if any of you are sure you know what's happening, I don't believe you because nobody knows, right? There could be external factors that come in. There could be political tax changes. There could be defaults. I hear that there's as many as 11 million non-performing, 11 million delinquent mortgages. I don't know if anybody's heard that number. So if that comes into the market, that's going to probably put some pressure downward on prices. But am I going to sit here and wait for that? Interest rates might be going up at that point, right? And if we're making some healthy investments, I'll just go buy a little bit more, I mean, if I'm looking 15 years, it doesn't really matter to me. But I'm looking forward to a really healthy discussion next week. Next week, I'm gonna suggest that all the agents participate, even if they're not looking to invest, because I think it's an interesting subject. But the reason that we're hitting the subject head on is, 25 times the activity. What was the search criteria, Robert, that it was? Are we in a housing bubble?
State bubble.
Yeah. On Google, it went up not 2.5 times, not 20%, not 2.5 times, but 2,400%. It's like 25 times as many people were putting in, are we in a real estate bubble or some similar term, right? So, that might be a little bit alarming. I'm not going to lie to anybody, but, again, if I don't really, if I got my financing, right, and I got my cash flow, and even if I go negative, if I put 100,000 down and the property goes down by 120 grand, so on paper I'm negative 20 grand, but over time that thing's going to get paid off. So I don't really care. Okay, that's Rob Lazar's personal opinion on how my investment strategy would be. Everybody's got to have a different one, but Anthony's giving me thumbs up. All right. So again, it's risk tolerance. So that's what I'm going to try to scare you away. I'm going to try to address the discussion about what happens, but my bias is going to be, who cares if the market goes down in a year or two? Okay. I don't really care as a real estate professional. I hope you don't plan on seeing your income drop if the real estate market crashes, because there's opportunities in every single market. Okay. We just need to adjust. Okay. I think, I read the book. I think it was, was it In Search of Excellence? One of those books by Peters. And he said the only differentiating thing over the long term is your ability to learn and adapt. So if you're of a mindset that I've figured it out and I'm not going to change, when the market changes, you are vulnerable. If you have a learning mindset, okay, and are flexible, you will be able to adjust to any market. And if we can adjust quicker, we're going to get our unfair Remax share of that market. Okay, so that's my 2 cents. We are at 10:31. I know we waited for a few people to come on. I want to take any questions. You can unmute yourself, ask me, put it in the chat.
What day? Hi, Rob. Good morning. It's Kelly. What day is the next session next week?
So Kelly, this is really easy. Tuesdays at 9:30. So just put on your calendar every Tuesday at 9:30, and I'll let you know when we're done. Maybe at some point we go to every 2 weeks or once a month, and the purpose of those meetings are just the people that want to invest some money to come onto the call. And I also want to say, we need to start thinking about, taking a few dollars, right? Because I think few of us have $100,000 sitting around, especially after tax time, to go invest in a property. But if we took maybe 5 or 10% of our transactions and pretended it never happened, life still goes on, right? And we still get by, and then we'd have that money to invest. So that's going to be something that I'll probably talk a little bit about next week, so that at least we can start putting some money aside if we haven't managed our investable cash. Any other questions?
Rob, I had a question. Bruce mentioned something that I think is very important because he's talking about the top tier and how they handle real estate in their portfolio. And I think my my question in the chat got a little convoluted. What I was wondering is if in Florida, if we start the investment vehicle for this group in another state that has a low income tax or a no income tax vehicle status, if that's something that either Bruce's accountant or I mean, I don't know who's accountant, but some accountant to figure that out.
I think if you live in New Jersey, I think if you live in New Jersey, you're going to pay New Jersey tax.
Yeah.
Okay, so I don't think you can get away by buying a property, and maybe you could shelter income if you plan on going there later. I'm going to mute everybody, and then I'm going to stay on for a couple more minutes for questions. So hang on. So, and then the other thing, Anthony, is make sure you show Bruce and Tom some love. Throw them some deals. They're here to help us,
Absolutely.
Any other questions?
Rob, there's one more point in the chat box, which is the focus initially going to be residential, or will you be targeting commercial investments as well? Will the ownership be a tenancy in common, and will all the investors be on the title?
So a lot of questions. So the initial focus is going to be to do residential because that's what we primarily focus on, and that's easier to get started. A commercial deal can take 6 months to close with expanded due diligence, and commercial financing is a little bit more complex. So I want to get this bus rolling. I want to get it started. I want to do it in residential real estate. I want to create a habit of wealth creation here instead of a habit of working harder next year. I want to see us get some residual income put together. And I just want to be real clear. I am not doing this for me. I'm not doing this because I want you to invest with us. I am doing this because I want to educate you, and it would make me eminently happy to hear a story 5 years from now that you made $250,000 because you did something on your own or you did something collaboratively as a group. But I just really, really think that we shouldn't be sitting on the sidelines, and we should be active in the market that we embrace, love, and live off of. So any other, I know that there's questions here. Unmute yourself. I'm going to stay on at least another 5 minutes. Lillian, you have some questions? No? All right.
I have questions. It's a lot of information. I'm in 100%. I've been reading books, How to Get a Millionaire, and one of the options that they mentioned, the author, is to work like this in a group and start investing. If you're gonna do it on your own, this is the best way to do it, and I'm 100% in. So I think the opportunity of what we need to work now is really go out and look for the nice properties and come to the meeting and say, we have this, I don't know, this property that may come on the market and has this income, and just share with you all and see if we can invest in that property.
Well, fantastic. And Lillian, I believe in it. And I want to see, we have a imposter on the group here. His name is Mark. He's not a realtor. What do you think of all this, Mark? You're an analytical.
Yeah, I'm very encouraged. I like the thought, some of us may invest in the stock market in mutual funds where you spread the money across a number of individual stocks and managing risk by spreading the money more widely. So that's one thing that I heard today that sounded good. Instead of like trying to pick the best property, picking a range of properties to manage the risk across a portfolio instead of a single one.
And what I'm also going to need to do is we'll have to get attorneys and accountants on here, because that's not my expertise, to figure out how we are all protected, right? When everything's going great, everybody's friends. But if there's a bump in the road, we just want to make sure that everybody is going in eyes wide open and everything is transparent and fair from the onset. So, you know, that's the foundation of it, Mark. And anybody else have any other thoughts or comments that could help me with next week or the following week's wealth webinar?
I'd be curious to know, Rob, in terms of like LLCs, if there's an umbrella corporation that's incorporated holding the shares of the LLCs.
So, Ellen, that's where I'm going to get accountants and lawyers involved at that point. And I look at it and I say, you know, if we're going to buy investment properties, we probably put in the contract that, you know, we're liable to perform, but we have the right to assign it to an LLC prior to closing. That's about as technical as I'm going to get there. And these are all details that need to be hashed out, but that's how I plan on addressing that. So, you know, if the rubber meets the pavement, as they say, and we only have 3 people interested, then, you know, we're not going to retain an army of attorneys and accountants. But if we have, you know, 20 people out of the 50 some people that have been attending, I think we now have a critical mass to do something really special in the business, and you know, special opportunities with people I care about a lot. So, any other questions?
So Rob, it's Christine Reynolds. I just have a question. So it's basically a syndication for buy-in, right? Like maybe shares in the LLC.
So,
and what would be? I guess it would depend on what the list price is on the investment property in terms of what the buy-in would be percentage-wise.
So I've been doing my own research, and I think like to buy with commercial financing where you can go in with an LLC, it's gonna impair the terms that we get on mortgages.
Sure.
Okay, so we're not going to get a 2 5/8 15-year fix. So what I'm going to try to do is I'm going to try to manage that risk either through insurance or through closing on these properties and then transferring them to LLCs.
Okay.
And protecting it that way. And there's risk with everything, you know. So if you transfer it to an LLC, there's a due on sale clause that's likely not to be invoked, but it could possibly be. So we're going to give you all the information, and then we're going to make that best decision as a group.
Okay. Yeah, I'm definitely interested.
All right. Anybody else? I am super pumped. If you're on video and you're super pumped, 2 thumbs. All right. It looks pretty unanimous. Brian, did you give us the thumbs up or no? All right. I think we got something special going here, and easy to remember. Tuesdays, 9:30, at least for the next 2 weeks. We might be continuing this, longer term, and we might just change the format to only people that are interested in buying. But I want to wish everybody a great week. This Friday's mastermind, if you want to attend. It's the listing attraction theory. Okay. I am super excited about this because there are listings to be had out there, and now is our time to rise and perform and attract. So if you're not otherwise committed Friday morning at 9:30, I welcome you to come. This will be sent out as a recording on YouTube on our Abundance in Real Estate channel. The link that you got today has last week's if you want to go back on it. One of the things that we might want to do in the upcoming weeks is maybe have a little workshop where I show you how I calculated the numbers that we did, and maybe put together an investment committee of people who are going to help us find these properties. So I'm super excited about this. This is one of the most exciting things I've seen in real estate, to see everybody get together with a common purpose and invest in our future. So thank you so much, everybody. Have a wonderful day.
Thank you.
Thank you, Rob.
Thank you.
Thanks a lot.
Thank you, Rob.
Take care. Bye-bye.